Well, hello there. It's an honor to meet you. My name is John Marshall, and I was the fourth Chief Justice of the United States Supreme Court. I'm also one of the most important people to ever have lived in America, and I'm also one of Professor Mark's idols. You should know why. See, back in my day, lawyers spoke Latin, and all I can say is, asanas malas foi que matram tatum concumbre nolisti mecum. See, in my opinion, this is Professor Mark's, one of his best weekly newsletters, and it will help you make money.
Well, thank you there, Professor Marshall. You're one of the most important men who's ever lived, and you've always been in one of my idols. So I enjoy you showing up, coming back from the great beyond. And back in your day, just like in today's day, there were certain market principles that were more important than others. And the reason why is because human nature doesn't change, right? A chart, if it's viewed correctly, it's viewed through the context of supply and demand. And it really shows human psychology. So we're going to see that in some of these charts, but we got to remember certain price levels are more important than others. If you know where these levels are, I'm not going to say it's easy to make money, but it's easier. These are called support and resistance levels. And resistance and important support levels can stay intact for a long time, probably longer than you even think. I mean, there's charts that where an important level has been intact for months, if not years, and this is called market memory. And levels that were resistance can turn into support, and levels that were support can turn into resistance. And we're going to see why. Now, there's potentially a lot of what we call false breakouts going on this coming up in this week. So resistance is a big concentration of sellers at or close to the same price level. When markets are moving higher, it's because the buyers can't fulfill or fill all of their orders with the sellers that are out there, so they have to offer to pay higher prices or they have to bid higher prices. So that forces the market into an uptrend. All right. So when we get to a resistance level, the tide turns, and all of a sudden the buyers can buy all they want to because at a resistance level, there's more supply than demand. So the opposite is true with support, but for this week, I just want to talk about resistance because we could be getting what we see or what we call a false breakout. False breakouts are in and of themselves good signals. A false breakout occurs when a stock trades above a resistance level. And within a few days, it comes right back below it and it comes crashing through it and it goes way back down. This is called a false breakout or a bull trap. When we want to see if something really truly breaks a level, we need to see if that level that was resistance turns into support. And you could see that under the section of our lessons where I talk about price levels. But just to put it in real time, this is what I want to talk about. So if the support breaks, or I'm sorry, if the resistance breaks, it goes higher. But there's generally some profit taking, and that could push the price lower. And the key is to see if that level changes. And I have a guinea pig back here because I love guinea pigs and I adopt rescue guinea pigs. And male guinea pigs are called bulls, so that's why that's there. I don't know him. He's not one of our guinea pigs. Right now, all we have is Dr. Puffenstein, but I think we've had 8 or 9 by now. We had Caramel, Turbo, Fat Porky. They're great pets. I think if you want a pet and you live in a city and a dog is in a good fit, you should definitely look into guinea pigs because they're Really cool companions. They're basically like miniature dogs. They all have their own personalities. All right, so this is just kind of an overview of what's going to be important to look at this week. We have a bunch of things that are overbought and at resistance. No, I can't get this damn pen to work. Overbought and at resistance. Healthcare is overbought. Financials, we got to take a look at this. So this upcoming week is going to be pretty important. It could give us an idea where the market's going to go over the next few months. This chart on SPY here teaches a lot of lessons. One is how support, come on, pen. It's like I got to click on it twice for torque. All right, so support can become resistance, and resistance can become support, and support can become resistance. Why does this happen? Well, some levels are more important than others, and for some reason in the 390 level is important for the SPY. That's what we're looking here. It's the S&P 500. The S&P 500 ETF, which is, we follow this because a lot of people trade it. And it's so close to the S&P 500, it really kind of doesn't make a difference. But anyway, support, why would a level that was support miraculously become resistance? Well, it's because people bought here, and when it goes lower, assuming they didn't sell, a lot of the people that bought say, man, I made a mistake. I want to get out, but I don't want to lose money. So they place their sell orders at the same price they bought at. And if they're enough, the level that was resistance becomes support. Here we have the opposite. The level that was support becomes resistance. Actually, I said that wrong. The level that was resistance becomes support. This is seller's remorse. Investors sold, the price went higher. All of a sudden they regret selling. They tell themselves they want to buy it back. But they don't want to pay more than they sold it for. That way they can kind of erase the mistake in their heads. So they place their buy orders at the same level they sold at. And if there's enough of these buy orders, the level that was resistance becomes support. And here, once again, we have support becoming resistance. All right, so this coming up week, we just got to watch how S&P navigates this 395 level. You know, we got our whatever, I don't even want to say, our friend, Mr. Powell, speaking on Wednesday, and maybe his comments might have some influence on the market, especially if they say they're easing interest rates. But I don't know, if the market moves higher on that, it's probably short-lived. But if we do move higher, there's a good chance we're going to see resistance around 411 because it was resistance before. And this is what we call market memory. A lot of times levels that were resistance or support can stay intact for a long time. If we move lower and we get to 390, well, we're either going to get a bounce or a sell-off. And a lot of people like kind of make fun of me. They're like, oh, gee, you know, you traders are like, well, if it gets here, it'll go here or it'll go there. Well, picture it as like an important level is like a fork in the road or a fork in the trail. When the market gets there, it's going to go one way or the other. And sometimes it takes a few days to figure it out, or maybe a few weeks. But stocks don't generally hang out at support levels for a long time. When they get to a support level, they tend to either break through or move higher. Well, actually, it depends on the level. If it's a resistance level, they break through and move higher. If it's a support level, they break through and move lower. This is just a more up-close picture of the S&P or the SPY, just for you shorter-term traders. I know in our class here, it seems like, I mean, we got all different types of styles and strategies, but a lot of you already know are short-term traders. So I'd look at, you know, 395 for support if we go lower, and we probably will. I mean, I wouldn't get too crazy. I mean, maybe if it breaks 395, we get to 390, but I don't think that'll be that big of a move. I don't know. I'd probably stay on the sidelines. If we get above 402, we could have a good chance for a move higher, and then we get back to that 411 level we talked about. All right, here we have our technology sector, which is important, basically because it's the biggest sector in the market. It's about a quarter of it, about 28% of the S&P 500 is technology stocks. We've kind of been in this trading range right here. We've been kind of neutral. My suspicion is we're going to move lower and get some support around this level here. And then we get to, when you have an important sector or get to an important level, well, then it's like we're either going to have a breakout or a breakdown. I shouldn't say a breakout. I should say a rebound. We're either going to have a rebound or a breakdown. So this is going to be an important level to watch this week. If XLK gets down there, let's just pay attention. If it holds and rebounds, it's time to buy. If it breaks down, it's probably a good time to sell or to go short. We can see the consumer healthcare sector, or the healthcare sector, is at an important level. It's also overbought. This sector doesn't get the attention it deserves, but it is the second biggest sector in the market. So looks like we've broken out. If we come back down, we'll see, does this resistance convert into support? Does that seller's remorse kick back in? If it does, it's a good signal. But if healthcare breaks this and technology breaks what we just talked about, then it's time to look for an idea on the short side. And it doesn't need to be a put or an option. It could just be buying an inverse ETF, and that's something that we talk a lot about as Stock Shopper. All right, what's that? All right, so Mr. Marshall wants to come back on. I think he's got a lot more important things to say, so I'm going to bring him back for a minute.
I made a lot of decisions that affect your life even today, and I've been dead for over 200 years. And don't try to contact me on your Ouija boards looking for stock tips. That's Mark's job. And I'm not, or was not, or have ever been Alexander Hamilton. I will not take questions for him. Now let me explain my thought process. In the Marbury vs. Madison case, my decision was, well, bona fide genius, I think.
Well, thank you, Mr. Marshall. I know it's pretty messed up that a lot of people think you were Alexander Hamilton, but it just kind of shows how dumb our society is. But you made some brilliant decisions, and it was because of you that the Supreme Court actually was able to, like, you made the Supreme Court the power that it is. And it was about Madison and Marbury. And it was as simple as, does the mail get delivered or not? So later on, you could tell us a lot more about it. But for now, I'm just going to keep walking through the markets. So now we're coming up to the financial sector here. And this is testing an important level. It's not enough to know if we're through there. Just because it's above it for a few cents, we still got to watch. The market's on the verge of a big move. And if financials fail and healthcare fails and financials fail, when I say fail, that means they don't get through the resistance and they reverse and the sellers take over. Here's our consumer discretionary sector. At this point, John, or I should say Mr. Marshall, because I should not, you're so much more important than I am, I would refer to you as Mr. Marshall or Your Honor. But, sir, this sector looks a little bit neutral. I don't really see too much going on there. This is an interesting sector. This is industrials. All right, dude. I'll let you back on in a second, man. I know you want to talk, and you should, but just give me a break. I just want to go through the industrial sectors here. I mean, look at this, dude. 100 is an important level, right? And why? It's because of psychology. Why is 100 an important level? Not even someone as brilliant as Your Honor or your Chief Justice Marshall can understand this, but it's just human psychology. People like to sell at 100, and just because it got up to 130, I mean 10130. I mean, come on, that's 1% away. That's not enough to say it's broken. So this is another thing we're going to be watching for a false breakout, potentially. If the level converts, then it sets the stage for a move higher. If this resistance converts to support, but if not, it could come right back in really quick. All right, Mr. Marshall. Okay, come on back on.
In 1803, President Jefferson failed to deliver commissions to 42 justices before the end of President Adams' term. This prevented these individuals from taking their appointments that were confirmed by the Senate. One individual, William Marbury, decided to mount a legal challenge against the Jefferson administration. Seeking to have his judicial commission delivered, Marbury filed suit against James Madison, the sitting Secretary of State. Madison was a bit of an ass. The Supreme Court agreed to hear the case of Marbury v. Madison in 1803 term. So early in February of 1803, I held a 4-day trial for the case of Marbury v. Madison. And even though that bitch Madison refused to appear, the court held that Madison was legally bound to deliver Marbury's commission and that Marbury had the right to sue Madison, therefore causing a problem. Yet the court also held that it could not order Madison to deliver the commission because the Judiciary Act of 1789 had unconstitutionally expanded the court's original jurisdiction to writs of mandamus. This type of court order commands a government official to perform an act that is legally required to perform. Because the portion of the Judicial Act of 1789 was unconstitutional, the court held that it did not have the original jurisdiction over the case, even though simultaneously holding that Madison had violated the law. So Marbury v. Madison was the first case in the Supreme Court struck down a federal law as unconstitutional. It was most significant for my role in establishing the Supreme Court's power of judicial review, or the power to invalidate laws as unconstitutional. Like I said, it is emphatical the providence and the duty of the judicial department to say what the law is. By asserting the power of judicial review in a holding that did not require the Jefferson administration to take action, my court upheld its own powers without coming into direct conflict with Jefferson, who would likely have not complied with a court order.
Wow, dude, that's pretty heavy, man. But I thank you for that. But you're one of the people who, it's one of the reasons why our country is great. And a lot of people don't know who you are. So I'm glad you showed up and speak your piece. And you're going to be in our stockjobbers.com Hall of Fame because you're just one of the most important people and most brilliant people, I think, who's lived. But anyway, so let's move on to the market here again and just kind of review these last sectors before we wrap things up here. And this is our our communication services sector. I don't know, it's in a little uptrend. I don't really see much going on here. Looked kind of neutral to me. There could be some potential ideas on the short side in the consumer staples sector here, because we can see we're overbought, right? The last time we got overbought. And these ETFs track these sectors. I probably should have said that at the beginning. But in the S&P, there's 11 sectors. And these ETFs track them, so we can chart these ETFs and get an idea of what's going on in the market. And if you can see like kind of what's going on behind the hood or underneath the hood, you can get a good idea of what's going on. So last time consumer staples was this overbought, it was a good time to sell. So what we are going to do in Stock Jobber, and I guess you could take a look over at the sectors section, we'll look through this and see if we could find some short ideas or some inverse ETF ideas. Just because you don't trade options, don't be afraid. There are ways that people who don't trade options can make money when the market's going down. We could do it by investing in reverse ETFs or inverse, sorry, not reverse, inverse ETFs. Here's our energy sector. As expected, we ran into resistance at a former high. Former peaks tend to become peaks again, so that's not surprising. Probably see a little bit of a sell-off here. A little bit of profit taking. All right, so I'm going to bring my good friend, Mr. Marshall, on again.
Greetings, citizens. I am Thomas Jefferson. My very first Madison was really Marshall versus Jefferson. It was a fight between me and him. And you can believe this or not, but this douchebag was actually my cousin. I was right and you were wrong. And oh, by the way, you were wrong on so many other things. Yes? Like what? Oh, please. The future direction of the economy, your foreign policy, your views on banking, slavery, agriculture. The list goes on and on, TJ. Well, I am going to have Grandmama sit me somewhere else next for Christmas dinner. We will not be sitting next to each other. See how you like that, punk.
Yeah, those guys are actual cousins. So, I mean, back then the country was a lot smaller. Anyway, let's just kind of wrap things up here because I know we're going kind of long. But anyway, this is our utility sector. Overbought through important resistance. This is a good example of how when markets are going higher, levels that were resistance become support. Resistance, will it come support? Will there be enough remorseful sellers trying to buy their stock back or their shares back that it becomes support? If that happens, there's a chance we go for another spin higher. If not, let's look for going lower. Here we have our real estate sector, which is showing you some really clear market principles that we talk about. You can check that over in the market principles section. Why would support become resistance? Well, buyer's remorse. People bought here. When the shares went lower, a lot of the people that bought thought, man, I made a mistake, but you know what? I want to get out, but I want to break even. I don't want to lose any money. So I'm going to place my sell order at the same price I bought at. And if there's enough of these sell orders, the level that was support will become resistance like it did here. So am I going to bring Mr. Marshall on again? Dude, you ready or what? All right, hold on, man. Mr. Marshall is putting his notes together. Because when he lived, there was like no computer, so he's probably pretty wowed at what the hell's going on here, right? I mean, he understood support and resistance, but he didn't understand that one day we'd have a computers. But this is the basic material sector. See, we're overbought. Once we're above these Bollinger Bands, we're overbought. This red line is called the Bollinger Band. This is 2 standard deviations above the 20-day moving average. And most trading should occur within 2 standard deviations of the moving average. So when something gets to an extreme, there's a tendency for it to revert because it attracts sellers into the market. So this is the boring sector. It's paper, chemical companies, but I mean, making money is not boring. There could definitely be some opportunities here. All right, everybody. So I think I'm going to bring on Mr. Marshall again, unless he's left. Let me just check it out. You know, he was he fought in the Revolutionary War with General Washington. So let's see if he has something to say about that.
Back in 1803, when I was alive, few people knew how important Madison versus Marbury was. It had a huge historical ramifications that will last up until this day. It established the principle of judicial review, and that is what they call a BFD in text messages nowadays. And as I said it before, I will say it again. Asanas malas fue que mastrum totum cocumbre nilusti mecum.
Well, we really appreciate that, sir. You got to understand, in our generation, 200 years after years, people are pretty uneducated and dumb. But whatever, we appreciate you being here with us, and we will, as stock market jobbers, we should read your writings and so forth. And I'm glad I got the word out, and hopefully some of the people that are listening right now will get books about you and read up on how important you are. All right, everybody, thank you so much for tuning in, and I will see you next week.